And we're live.
All right, good morning. This is Senate Health and Welfare. It is Tuesday, January 21st. And welcome back after the long weekend for many folks. It was a holiday weekend for Martin Luther King Day. So we're glad to be here after that. We are going to listen to Nolan Langwheel present Health Insurance 101, and we have support as well from our healthcare advocate. Okay, so Nolan, welcome and go right ahead.
For the record, Nolan Langwheel, the Joint Fiscal Office. The plan today is to just do a very high level overview of Health Insurance 101. As I've said in the other presentations that I've done, my goal is to put a lot of these concepts on the table. But if you want to go down the depth, I'm not necessarily the correct person to get into the weeds on some of this stuff. Like why is there HSAs and HRAs? I can just help explain what they are and help understand the role they play, but how they work and eligibility and why would an employer do this or that, like that's not my expertise. So again, my goal is to just put these concepts on the table and I can answer your basic questions about them. But if you have more in-depth questions, I recommend you bring in the experts on that. Speaking of experts, I did invite Mike Fisher to be here because a lot of times there are questions that come up. And Mike has a depth of knowledge. He's in the field. He's working with people and just understanding a lot of these things. So I did invite him to be here to sort of answer questions that come up that I don't know the answer to. So first thing I've been doing this on my presentations is the disclaimer that a lot of the data is old. And I said this in my two other previous, it's the same slide, same premise, same quality, just same disclaimer. I'm going to talk about insurance coverage and do a high level market overview. I'm going to talk about actuarial value and cost sharing, out-of-pocket costs, HSAs, HRAs, FSAs, risk poolings, what's in a premium, a basic overview of the market share stuff, and then just kind of a quick overview of like what does rate review look like when they're looking at insurance plans and solvency, the role of solvency in this, and who looks into all those things. Well, I haven't shared my screen yet. Sorry. Apologies. Welcome to Monday. All right. So here's a slide that I've used a million times already in this room. This is, again, just to kind of set the stage to show you the background. Today, we're going to be talking about the private insurance. So that's all the gray. That's sort of the area for which we'll be covering. And so most of our insurance market is employer-sponsored insurance. But when we talk about employer-based, you have a self-insured and you have your insured. And under the insured, you have large group and small group. And I'm going to talk about what do I mean by when I say self-insured and insured. That's the next slide. And we're also going to talk about the individual market, which has qualified health plans and reflective plans. And military is part of that commercial per se, because it's not government, even though it's the government, but it's still a private insurance plan, but we don't regulate it. It is the federal government. This chart, I think I showed you in this previous one. But again, this just sort of gives you a sense of like, when we talk about people say, the legislature wants to help regulate insurance or bring down costs or whatever, this is sort of the area, the segments of the market for which you have some legislative control over. You can see the majority of it, you do not. So Medicaid, obviously, we control Medicaid policy. It's a federal state partnership, so we have say over the policies, and we do the budget, or you do the budget on Medicaid. Otherwise, individual, small group, large group is where you have legislative purview. You don't have purview over Medicare, that's federal. The self-insured, which is a large portion of the private insurance market, is not regulated by the state. It's regulated by federal law, not state law. And then uninsured, obviously, we don't regulate uninsured because they're not anything to regulate. So just again, this gives you a sense of the small slice that people don't realize that you own, that you have some kind of regulatory, legislative influence on. So again, the gray is the commercial market, and you can see almost 75% of that are self-insured. I'll get into what that is in a second. And then 7% are large group, 15% is small group, and then 4% other. I get that question a lot. What is the other? And this is how this is pulled from other documentation. And what that group is really just a lot of folks who are residents who have insurance products by out-of-state corporations. For instance, I might live in Vermont, but I work for some tech company based in Missoula, Montana, and I'm covered by Blue Cross Blue Shield of Montana. So that just sort of, they just sort of fall into that bucket. So, but you can see the majority of the folks are in the self-insured market. So what do we mean by self-insured? So in insured, that's basically like a normal, when you think of insurance, you think of like, I'm a business or I'm an individual and I want to buy insurance for my business. I pay a premium. And as a result, the insurance company is bearing the risk, right? Just a regular, when you think about it from a regular standpoint. But self-insured would be like a large company. There are small companies that are doing this now, but the majority are these large companies who are saying, you know what? I think it's rather than me pay a premium for every single employee. I think it's cheaper. We, as the company, assume the risk. We still hire Blue Cross Blue Shield or Cigna or some other insurance company to provide third-party administrator products. So we still go through their business because they have the IT systems, they have the relationships with the hospital, they have all the billing stuff, they have all the administrative behind-the-scenes stuff. So you're buying a product through them, and they'll adjudicate your claims. So self-insured, I might still have a Blue Cross Blue Shield card, but the company itself is actually assuming the risk. So with a normal product, if I'm just buying an insured product and I have an employee who has cancer, well, the insurance company assumes that, and they might reflect in the premiums later. But if I'm a self-insured company and I have somebody who has a very high risk thing or cancer or something like that, the company would assume the cost. So that's the difference between self-insured and insured. For the insured, that's usually the small individual or large group markets for which we regulate. But the self-insured, we do that. So again, one way to think about it is insured. Insurance company assumes the risk. Self-insured, I myself, my company are assuming the risk. So we're going to talk really more about the insured market now. So there, for the individual plans, so
Just a quick question about the self-insured.
Sure.
So are there as many different insurance plans as there are companies that want to be self-insured?
I couldn't answer that.
We don't know.
I think the major self-insured. No, I don't know the answer to that.
Yeah.
I don't know how many companies, even though it's a large percentage of our market, a lot of those folks did this. So, and then the state is kind of this weird anomaly because self-insured, but it's the government self-insured, so it's not the way we normally think of self-insured. But the teacher plans, they're different too, as an example. But like Global Foundry, right, for instance,
Right.
would be a company. Mike wants to say something.
So, right, you mentioned healthcare. You mentioned Global Foundries. There's probably some out there that are doing it manually themselves, but for the most part, they're hiring a third-party administrator who we do regulate. I mean, I think DFR could tell us how many third-party administrators are out there and how many lives they cover.
Yeah, they used to put this report called the ASSR report, and I had it on there, but the last time I looked at it, it was there were some errors with it, so I think they pulled it. They found some errors, but it's a very good. It is a good document. So we think about the insured market. We're really talking about individual, small group, large group. So individual market is approximately 34,000 people. This is as of June 2024. This would be folks who do not get any kind of employer-sponsored insurance, right? So this would be either on the exchange or I just don't have employer-sponsored insurance and I'm buying a product directly through the insurance company. So there's about almost 35,000 people. This is as of June. 82% of those folks are receiving some form of state or federal tax credit. So in short, premium assistance. So they're not paying the full premium. 28,000 of those folks have some kind of state and federal. 6,000 of those folks are actually paying the full price. Now, usually they're not always, but they're usually buying it directly to the insurance company. Whereas if you're going to get a federal or state assistance, you would go through the Vermont Health Connect. I'll move the star just so the picture, if you know what I'm talking about. So small groups are defined as up to 100 employees. This would be small employers. It's approximately 37,000 people who are covered through a small group plan. And then we have large group plans, which are at least 101 or more employees. And there's about 17,500 folks. This is 2020 data for that one. Hopefully we get some more data soon on this. So again, I mentioned that if you are an individual or small business, you can go through the health benefit exchange. We call it Vermont Health Connect in Vermont, and it's administered by the Department of Vermont Health Access, which is part of the Agency of Human Services. So I'm going to get into some of the basics or more depth. So one of the most important concepts when we talk about insurance is this thing called actuarial value. And it's the average share of medical spending paid by a plan for a defined set of covered services across the population. So for instance, if a plan has a 70% actuarial value, on average, the plan would pay 70% of the medical spending for covered services, and the beneficiary would pay the remaining 30% through out-of-pocket, such as deductible, co-pays, and co-insurance. So in general, when you're buying an insurance product, the higher the actuarial value, the more rich the benefit, the more expensive the premium. The Affordable Care Act established these things called metal levels. And I know I'm telling you all things you all know, but I'm just going to walk through it.
Well, I don't know how much.
Yeah.
Yeah.
So the metal levels was a way to sort of tie a color to an actuarial value. So if you think about a bronze plan, it's roughly 60%. It's a range, it's 58 to 62, but they kind of, so the bronze plans are around 60%, the silver plans are around 70%, the gold plans are around 80%, and the platinum plans are around 90%. So again, the higher the actuarial value, the richer the plan, higher the premium. Or the other way to look at it is the higher the actuarial value, the lower out-of-pocket risk you have. So, so cost sharing, when we talk about cost sharing, we're generally talking about deductibles, co-insurance, and co-pays. We're not talking about premiums. I used to get that question all the time. Does premiums count the out-of-pocket? And the answer is no. Premium, the way I look at it is your premium is buying your out-of-pocket product. So yes, you're paying your premium out of pocket, but that's not your out-of-pocket expense. What your premium is or how much you pay in premium will determine your out-of-pocket expense. So the higher your premium in general, the lower out-of-pocket exposure you're going to have. So I took this snapshot just to kind of lay out like what these plans might look like. Now in the exchange, there are a lot of different bronze, silver, gold, and platinum plans. This is just a snapshot of one particular group, what is known as the standard plan. So you can see that the bronze plan has a deductible of $6,500. The silver plan has a deductible of around $3,500. Gold plan has a deductible of around $1,400, and platinum is about $450. So you can see that as the plan gets richer, the out-of-pocket exposure goes down. Now, within the different product, now not every bronze plan, silver or gold or platinum is going to have this deductible. What they're trying to do is they're trying to look at it across the whole benefit. There might be other plans. For instance, there might be a gold plan that has a higher deductible, but different levels of copay, or it might have a different out-of-pocket max. They play with all the different knobs within that to try to get it into that rough actuarial range. That's why we say it's range, and it depends on what the product is. Now, this one's a little confusing because there is this weird anomaly that I think is worth quickly discussing. But in general, I said, well, as your actual value goes up, your premium will go down. Well, with the exception, if you look at the bronze plan, it's the lowest at $6,500. It's $850 Blue Cross Blue Shield. The silver plan price goes up. Then if you look at the gold plan, you would think the gold plan with a lower deductible would have a lower premium. And in this case, it actually or have a higher premium. It actually has a lower premium. And the reason for that is this thing called silver loading. And I don't want to get into too much weeds about silver loading, but in short, it was this thing where the federal government, under the first administration and the Trump administration, there was this thing called cost sharing reductions. And it was a way to help people pay their co-pays, deductibles, etc. It was a requirement of the Affordable Care Act, and it was funded through the federal government. The first time the Trump administration came through, it said, we're not going to pay for that anymore, but it didn't revoke the law. So it put the liability for that onto the insurance companies. And the insurance companies, of course, would pass that on to consumers. But then somewhere along the way, somebody thought of this idea that if you can add those extra costs to silver plans, and the reason we use the silver plans is because that's what the federal tax credits are tied to in the premium assistance. If you can add to that, when the federal government paid the subsidy, they're actually covering a lot of the costs of those additional costs. That's an easier way of sort of dictating that. So or explaining that. And the federal government, knowing this was happening, has actually allowed it. So it gets confusing, but that's why this is their anomaly. And the reason I even talk about it is because there's a very good chance this committee will be talking about merging and unmerging the markets down the road, which is tied very much into the silver loading concept. And without going any further, that's why I put this on the table. So later on, you can say, oh, remember we talked about how some of the gold plans are actually cheaper. Mike looks like he wants to add something. Please do.
Can I just say, Nolan told the first chapter of that story well and accurately. The second chapter is a second chapter, which is, maybe I'll just say, continues in that same direction, but also recognizes the true cost of CSR, the true value of CSR.
Public sharing reductions.
The true value when we rate those plans, cost sharing reductions, thank you. And so this year, for the first time, we're doing that. And that's why you see those higher gold prices, lower gold prices, sorry. And the board's actuary estimated that we think that had a $40 million value to Vermonters. It's not cash exactly, it's increased buying power to get a richer plan. And that it's all federal money. There was no requirement for state money.
So clear as mud. And we hope that the federal government will continue to allow states and consumers to do this, but we will find it.
It's all based on the tax credit.
And so I imagine not many people have a silver plan. They're all opt for the gold plan.
Now they will.
That was my question in finance the other day. Why wouldn't everyone pick the gold?
So now
But
I do. But when it first came out, the idea was you're tied to the silver plan. And the gold plans were more than the silver. But if you decide to buy a gold plan anyway, but you had a subsidy, you pay that difference. But now it's a different story.
And we just got done with enrollment in the middle of last week. I think it would be great to get DFR to give us the numbers when they crunch them and see what actually happened.
It'll be interesting to see.
And forgive me, Noel, so the silver plan is loaded from the gold onto the silver and makes up the cost that takes off of the gold, correct? Is that what
Not
you're-
off the gold, it's loaded on the additional costs are just loaded onto the silver plan, which makes the silver plan more expensive.
It makes the gold plan cheaper and kind of pays for it. And if that's the case and more people want to be on the gold and nobody's on the silver actually paying those costs, that code would cover the gold plan. Or am I not understanding this at all?
Not exactly. I think the
I know where you're going.
the federal tax credit is based on the silver cost.
Yeah.
And so the money comes and follows them to the gold.
Oh,
They're still paying.
Federal money.
The difference is they're still getting the same level of subsidy.
Yeah.
Difference is that they don't have as much of a leap when they want to buy gold plan. Used to be that a difference, and now there's no difference to pay.
You kind of just say, a minute ago, I said DFR, I meant DEPA.
I used to use the gold plan all the time for all my employees. And I remember in 2017, I was only paying $495 a month for each employee. 2018, I paid $549 a month. 2019, just before I sold my business, I was only paying $617 a month for the gold plan.
Yes.
And I see it's $1,219. Wow.
Now, every gold plan is differently priced.
Yeah.
There are gold plans that are a little cheaper than this, and some that are more than this, but your point is, yes.
Yes, they, I also
Going
paid,
down,
I also paid 100% for my employees, never charged them any. So,
you see when I break.
I was only as good as they were.
13.
I was only as good as they were, so.
It's a lot cheaper
Little
than-
duct tape.
So speaking of out-of-pocket costs, because that's really what actuarial value is. So Joint Fiscal Office does this thing called the basic needs budget. And I do the health portion of it. And when I'm trying to figure out how much different out-of-pocket exposures are for people, we're looking at what they think the premium, what they think it's out-of-pocket costs. I looked at this information. I got this from what's called VCures, which is an all-payer claims database at the Vermont Care Board. And I found this fascinating, so I threw it in here because I think it's really useful. This is the median out-of-pocket cost that Vermonters paid in 2023. This only counts people that have 12 months of coverage. So it doesn't include people who only had 6 months of coverage. These are the people who were just covered for a full year. 30% of folks cite individual and family plans. Only 30% of folks had, and this was with a claim, had an out-of-pocket cost. 38% had less than 100%, and just 49% had less than 250. Then the other end is 30% had greater than 1,000, 11% had greater than 1,200, only 3% had greater than 5,000, less than 1% had over 10,000. Now, that's not meant to diminish the experience of those folks who have claims, but this is just meant to look at the proportion of folks. I think it was revealing because I didn't realize it was, so you can see that median income was, or median out-of-pocket cost for an individual was $260. It was $2,000 for a family. So this 2023, when I looked at this year over year, this number hasn't really changed a whole lot. How much people pay in the premiums changes, but the actual out-of-pocket experience hasn't really changed a lot. So the caveat to that, though, is that the use of these employer-funded HSAs and HRAs, health savings accounts and health reimbursement accounts, has increased significantly over the years. So when I look at the out-of-pocket costs, and I'm saying, oh, it's $260 for an individual and $2,000 for a family, what I don't know is how much of that wasn't paid by an employer and not the individual through their HSA or HRA. Because in the data, it only shows up as out-of-pocket cost. Because I might show up and pay the out-of-pocket cost, but what doesn't track is, well, my employer gave me that money to do so. In 2021, according to the Vermont Household Health Insurance Survey, which, by the way, is being done this year, and we'll have new data, but the most recent is 21, so it's 4 years old. 34% had an HSA, 13% had an HRA, and 9% had both. So these numbers have likely changed over the last 4 years, but just to give you a sense, if I had done this 10 years ago, the numbers would have been minuscule. So what exactly are HSAs and HRAs? So an HRA, health reimbursement arrangement, is employer funded. And it's entirely funded by the employer. And it's often sort of a notional, unfunded notional account. So it's not that I say, okay, I'm going to do an HRA and I'm happy each of you have an account that I'm going to put extra money in it. It's more like I'm on the hook for this. But if you don't spend it, you don't get it. Keep it. I, as an employer, keep it. So a lot of times what a lot of employers are doing with these HSAs and HRAs, and I've seen this happen, might be, let me use an example. they offered plans to their employees with a $1,500 deductible. So now what they're doing is they're saying, you know what, cheaper for me to buy a plan. As costs are going up, the plan with a $3,000 deductible is a lot cheaper than the plan with the $1,500 deductible. So what I'm going to do is I'm going to buy the cheaper plan with the $3,000 deductible, but I'm going to do an HSA or an HRA worth $1,500. So that in short, my employees' risk hasn't changed. I'm just changing how I pay for it. Now, the idea behind an HRA would be, and if my employee doesn't use that $1,500, it's mine. I never spent it. With an HSA, this is going to be, it's tax advantaged. They're usually tied to a high deductible health plan. It can be employer or employee funded, so people can do it as an individual. But if I put $1,500 into your account and you don't spend it, you keep it, and it rolls over with rules. There's lots of rules around it. So that's the difference between the two, and why someone would pick an HSA versus an HRA employer. That's an individual business decision. Now, I might, as an individual, might say, well, I don't have an HSA through my employer, but I want to create one. There's this tax advantage, and I know I'm going to have these costs. So there's different reasons why they may or may not, but that's to give you a sense of how these are changing the market and the flow and employer and employee decisions on how am I going to have insurance. So as an employer, as you would know, there's a lot of options out there, and you want to provide a product, but how to pick one, there's so many different ways. It's gotten more complicated as employers try to navigate the health insurance market in a way that doesn't put them on the hook, but make sure that their employees are covered and getting a good benefit. Then you have these FSAs. This is a flexible spending account, which is quite different. It is set up by employers for employees, and it allows employees to contribute a portion of the earnings to pay for these things. So usually this is set up by the employer, but I might take X amount of dollars out of each paycheck each month because I know I'm going to have expenses, and it can cover a little bit, like a broad range. It can cover your dentist co-pays. It can cover all kinds of stuff. We are offered these to this day. I actually don't participate in one, but it's a way to help people pay who anticipating have medical costs have get money aside. This is just a chart I threw in here. I'm not going to go into it. It just says the same thing. Now we're going to get more back into the depth of insurance weeds. You're going to hear a term called risk pooling. And again, when we talk about when the bill, if the bills, I don't think you have one on your wall, but I know there's one in the house, H35, I believe, that is about merging the markets. And you're going to talk about individual and small group. And this is around merging the markets or both. Yeah, but this is all about risk pooling. And risk pooling is a very fundamental concept in insurance. And the idea behind it is allows higher costs of the less healthy to be offset by the relatively lower costs of the healthy. And in short, the idea is that the larger the risk pool, the more the risk is spread out. And then there's things like community rating, which is when a health insurance provider is required to offer health policies within a given territory at the same price to all persons, regardless of their status. And a guaranteed issue, and I'm going to explain why we have all these things in a second. Guaranteed issue is when a policy is offered to any eligible applicant without regard to health insurance. So the idea behind that is if you have risk pooling, and if the healthy folks are paying, but the unhealthy folks are offsetting it, if I'm healthy, why would I even bother getting health insurance until I need it? And that's why you have all these different things. That's why you have open enrollments, closed enrollments. That's why you have these things around pre-existing conditions. The idea is to require everyone either be in or out. So if everybody waited till they were sick to buy health insurance, then only the sick people would be in the insurance pool, and insurance would be completely unmanageable. And when healthy people get sick, okay, now I'm going to buy more insurance, but now they're not healthy anymore. So that's the basic concept behind insurance, right? And there's all these different things, parameters within law that help kind of keep that market stable and equal.
When did our community rating go into place?
Although
No, I can't remember.
I think like my first year here, so maybe around 2000.
Yeah, I mean,
That sound about.
so I remember a time,
That late 90s, early 2000s.
with some enhancements that happened in the Affordable Care Act between the
Yeah.
years.
yeah. I remember a time when that we didn't have that. And people with kids who got very sick would all of a sudden were paying so much more.
Or kicked off their insurance
Yeah.
or.
Yeah, but my son took a year off going to college, got health insurance for 6 months for $300. That's the minute he turned 40, that
Yeah,
it would have gone up to $3,000 a month. So
And so the idea also behind that is to try to have as large a risk pool as possible, because in theory, the larger the risk pool, or the healthier the risk pool, the lower the premium. Now, of course, there's different risk pools, but we'll get into that.
Can I just make a comment real quick?
Sure.
That is really apropos nothing and everything, but I have to really keep my mouth shut when we go through these slides, because anyone who's lived in countries that have universal health care, it's so much simpler, so much easier from the perspective of the person, the citizen. Just little money's taken out of your paycheck every month, and boom, you're good. Taken care of.
Mhm.
And it's the ultimate example of risk pooling, because everyone's in it.
Mhm.
Just have to say that.
Yeah.
It's helpful for me to vent a little bit occasionally.
Yeah.
Because this is so complicated.
but the state that's closest to doing that is Hawaii. They don't have ESI.
What about Oregon?
And, like they still have self-insured. Federal.
we tried till the bill came.
We
in.
tried until the bill came
What
in.
will come
It's hard for we're a
Yeah,
small
we're a
risk
small
pool. We're teeny weeny compared to them.
And now we're old.
Yeah.
And so twice we've tried, and the bill has come in. And it's never come up for a vote because the cost per individual would be very high.
I'm not suggesting that we should do it. I'm just saying there are examples of
Yeah.
other ways of doing it out in the world.
Well, it would be nice if it happened for a broader level.
Yeah.
Yeah,
Ours was modeled on Taiwan.
right.
I was here during those times.
Yeah.
No, bad.
You're right.
Not responding because it's a political statement, and we're very political, but Vermont was only one of 2 states that had merged its markets, individual small group markets at the time in 2017. We are temporarily unmerged and are slated to reemerge in January of 2026. Again, this will be a discussion I suspect this committee will be having, so I won't get too much weeds about it, but it's an effect 71,000 lives, and it'll be part of that whole silver loading conversation as well. Then you have this concept called adverse selection. That's when an insurer or a market as a whole contains a disproportionate share of unhealthy individuals. So if you have different two risk pools, you might have sicker people in one, healthier people in another one. A common example of this occurs when people are allowed to wait until they know they are sick and in need of healthcare before purchasing health insurance. So again, this is that adverse selection, which is why we don't allow for open enrollment periods. And there's like, you can still get insurance outside of an open enroll if you have a special circumstance, if you get divorced, or then you can, there's some other ones. Turn 65.
It prevents people from getting life insurance before going skydiving.
Yeah.
Right, there's suicide exclusions in
Yeah.
$5 million life insurance.
So the ACA instituted an individual mandate. The tax penalty as one measure to try to reduce this adverse selection. Now, it was eventually eliminated. But the idea behind that was to try to, again, get people to go into the pool to buy the insurance. There's an example I was going to use, but I get to that later on, actually, so I won't get into that. Actually, this is what I was thinking. There's also this thing called risk adjustment. Under the Affordable Care Act, the Center for Medicare and Medicaid Services, CMS, collects funds from insurers who enroll with more low-cost health people and distributes them to insurers who enroll more high-cost people. So if there are two insurance plans in the market, and let's say one is filled with this, I'm going to use this example because this is what my predecessor used to use, but you have two pools. One's the bunch of aerobic constructors. And the other pool is a bunch of coal miners, right? They're going to have very different health experiences. And the idea behind that is that when this group, which is healthier, and this group, when people buy insurance, they're going to all go to the healthier one because it has a cheaper premium, and it's a creative spiral. So the idea behind risk adjustment is that the folks in this group, or the insurance from this group, actually pays this group to kind of help offset the market a little bit. Otherwise, it'll be a monopoly. So that's the basic underlying concept of how risk adjustment happens.
More expensive for the coal miner.
So on the exchange, we do have risk adjustment where one company is opposite or paying the other company some money in risk adjustment. So what goes into a health insurance premium? Well, there's a lot of things that go into it. One is your medical and pharmaceutical costs. This is what we would call experience, the experience of your pool. The people expected to be insured in that pool. Again, you expect to have a lot of sick people. You expect to have a lot of healthy people as your population constant. You have administrative costs. That was everything from product development, sales, enrollment, claims processing, customer service, contribution for reserve, and regulatory compliance. It also includes taxes and fees and assessments, which the state of Vermont does have. You have, in addition to normal, I think, insurance tax, there's also what's called a claims assessment, where every insurer in Vermont pays, I think it's 0.1, it's almost 1% of their claims, and it goes to the general fund. And that's a tax that's out there, but the insurance companies pass that on to the consumer. We have laws and regulations. There's things that mandates, for instance, where the insurance company is required to do, and those all have costs. If you're required to cover these certain services, and there's going to be an impact on the premium. Your plan design, again, you might have two gold plans. One's a little cheaper than the other one, but it's within the actual value. And then your market competition, like is if this company is coming in and well, you can't just weigh it in. They might say, well, we want to make sure our premium stays competitive. So they're going to take into mind, like, okay, what's our costs versus how do we make sure that we retain our customers or get people to buy from us? So the basic economics 101. So this is a slide, a picture that I stole or borrowed from AHIP, American Health Insurance Plan. That I thought really kind of laid out, like, what isn't a dollar? And this is from 2020 or 23. But they tried to, this is also nationwide, so this isn't Vermont specific, but it gives you a sense of what goes into a dollar in premiums. And you can see it's prescription drugs, it's inpatient, outpatient costs, administrative costs, quality cost containment, taxes and fees. And then a quick note about this thing called medical loss ratio. And that's the percentage of our premium an insurer spends on claims and expenses. The Affordable Care Act requires most insurers that cover individual small businesses to spend at least 80% of their premium income on health claims and quality improvements. Blue Cross Blue Shield testified, or didn't testify, but they were in the room when I did Synow's Healthcare, and they said they're over 90%. So so they were, and I think MVP was in that same boat. I don't think anybody in Vermont is as close to that 80% range, but it was a requirement.
Is that because they're not for profits?
I don't know. I also think they're just not gouging.
Can I just say, interestingly, I understand both carriers, say it the other way, have a 6.2% administrative costs. Yeah, the rest is claims. Interesting that they're both identical.
So they're like 90.
Pretty low.
Very low.
Yeah, very low.
Yeah, which means they're over 90%.
Yeah, well, that
Seems low.
Yeah, which
as compared with other places in
Yeah.
the healthcare environment that have higher admission.
So Blue Cross Blue Shield of Vermont has the largest share. They're roughly 60 to 70% of their own premiums for the major medical. So we're talking regular health insurance, say medical, major medical. We're not talking about life insurance or those stuff. We're talking major medical. MVP had the second largest, again, this is in 2021. AMP has the second largest, around 25%, and Cigna's around 5%. This may have changed some, but I don't know what the number would be. But Blue Cross Blue Shield is the only Vermont-based health insurance company. MVP is based in New York, and they have, I believe they have Maine, New Hampshire too. No, they don't have New Hampshire, but they have Maine, in New York, and Vermont. Blue Cross Blue Shield is only
Just
just New York. Oh, just New York and Vermont. I'm sorry.
used to be the years.
Okay. Blue Cross Blue Shield of Vermont is only Vermont, and they're actually in statute. It doesn't call it Blue Cross Blue Shield, it's called some kind of market or hospital something association or something, but they are in statute. So health insurance regulation, this is similar to the other slides, took Medicaid out. This gives you a sense of how small, when we talk about the insurance market, this is really the market that we as the state have regulatory influence over. The Green Mountain Care Board looks at health insurance rate review. So insurers are required to submit plans and they have to review them, and then they can, there's a whole review process and then they approve them. The healthcare advocate has, actually, I think I'll get to that later on, but they have, what's it called? It's called, party status, thank you.
Right.
Yeah. So they get,
that.
and it used to be, so there's this whole process where the Green Mountain Care Board, you file, the insurance file the plan, there's a public comment period, there's opinions, there's public hearings, and then there's a decision. And there's a time frame for each of those particular things. And it used to be where, when it was in person, it's all remote now, but when it was in person, you have 5 members of the Green Mountain Care Board up in front of the room. On one side, you have the insurer sort of posing their rates. And on another table across the room would be healthcare advocate and their folks who get a chance to sort of cross even them and the insurer on their particular, why they're doing these claims or what's in their premiums, or did you think about this, or why did you do that? So that's what we meant by party status. The Green Mountain Care Board is actually tasked in statute with determining if the rates are excessive, inadequate, or unfairly discriminatory. That's part of the actual review. They have to determine if they're affordable, promote quality, and promote access to healthcare. This is all part of Act 48, by the way. Act 48 was the bill where the state tried to do a unified universal health care system. That's the official term, but most people refer to it as single payer. But the Green Mountain Care Board was created at that time partially to oversee that system, partially to also to provide the regulatory stuff during the transition of that. Of course, there was never a transition, so they continued to be the regulatory body. Prior to that, it was done by what was known as BISHCA, Banking, Insurance, Securities, and Healthcare Administration. So we used to joke around at the CHOP, the Healthcare Administration, used to have the CHOP. And that was moved out of there and was moved to the Green Mountain Care Board. All the DFR does still have, and I'll get to that then. And prior to BISHCA, back in the 90s, it was Healthcare Authority, which I think was a 3-member board. So Vermont,
ERC.
yeah, well, it's a little different, I think, but the point is that Vermont has continually tried different regulatory structures for how we regulate health insurance. So
The hospitals.
So the board has to look at all this stuff. Does it protect solvency? And then, just consider changes in our healthcare delivery, payment methods, contributions to reserve, et cetera. As I mentioned, the healthcare advocate has party status. So these are all the things that the board is charged with when they're doing the regulatory stuff. Department of Financial Regulation is in charge of the solvency piece. And so in statute, it's very specific. So Vermont law requires the authority to protect consumers by ensuring the solvency, liquidity, stability, and efficiency of businesses that offer financial services and products. which include health insurance. DFR considers insurance solvency to be the most fundamental aspect of consumer protection since it directly relates to an insurer's ability to pay their claims. So a critical part of that, determining insurer's solvency, is to monitor their surplus. The surplus is the amount of assets remaining after accounting for all liabilities they must pay out. So in short, the idea behind solvency is, will insurer be able to continue to pay the claims? Will they run out of money? So this is an important piece. So whenever the rate filing is happening, Department of Financial Regulation looks at this and provides a memo to the board saying, yes, we think the company is financially sound and should be able to continue to pay its claims. Or it'll say, we have concerns that they may not be solvent and that we have concerns about their ability to pay a claim, and we'll make a recommendation. We suggest you increase the contributions to reserve by X, Y, or Z. And then there's a whole slew of other important insurance terms that you can go to on this link. I'm sure that everyone will take time to look at them. But anyway, like I said, this was meant to be a very high level overview to sort of introduce concepts that most of you have heard of, but just to touch base on as some of the bills that you will have before you will start getting into the weeds of this.
Thank you. This is good. I think we might be coming back to some of this as we look at some of the bills that we have in committee. And it will, whatever happens here also will be down in finance. So this is,
the
falls very much,
insurance pool and risk.
all of that, solvency,
That is-
all that. Yeah. But it's important for us to understand, because whatever we do from a policy perspective could influence what happens for the payment, the solvency, the rates, et cetera, et cetera.
A history of wanting to put more services, required services on insurance plan. They need
Yeah. What does that do?
that the money, finance generally is the one that says, what will that do to premium? And you're always trying to find this balance between giving everybody everything they want and they're going to pay for it, because if they can't pay for it, they're not going to get it.
No, and thank you. This is helpful. And we'll have you back. I mean, you're going to be here all year, so that's great.
Be here all year.
Okay. So we had scheduled in some folks just to give us an introduction to who they are and what they do, related to our work in here. And it's Joe Maza Olson on Zoom. So we'll just hear, so that 5 minutes apiece. We'll come back to this probably going forward. So just helpful if you can give us a quick update and introduce yourself for the record to the committee. We'll start with you. Thank you. And we're late as usual. So for those of you who are hoping to be able to talk more, we will come back to this another day. But that for today, it's really a quick intro. Thanks.
Senator, I'm sorry, it's hard to hear. Did you want me to introduce myself? Are you ready for me?
Yes, go ahead, Jill. Thank you.
Okay, great, thanks. Good morning. I'm Jill Olson. I am the Executive Director of the VNAs of Vermont. So we represent home health and hospice agencies, and I'm sorry not to be with you in person. I'm at a regional home health and hospice conference with some of my members, so I've had to do it by Zoom from my iPad, but I hope you can hear me okay.
That's very good.
Okay, great. And sorry for the angle. There's the camera's in an odd spot on iPads. I'm sure somebody has figured out a better way, but I'm too old for that. I have some slides that I'd like to share with you. Oh, looks like I can't share my screen. There we go. Okay. Hopefully, I don't know what it's going to broadcast now because I can't see. Oops. Okay. Okay. Can you see my slides?
No. Jill, I think probably given time, can you talk through your slides for
Yeah,
us?
oh, here it goes. It's about to go.
Okay. All right, we got it.
Yeah, I see him now. Okay, you see him?
Yes, not yet.
Okay, great.
No, not yet.
Let's try this. Here we go. How's that?
Hey, there we did it. You did it.
Yay! Okay, wow. I had technology trouble in house healthcare too. Maybe it's time for me to retire. Um, okay, I will go through this quickly. How much time do you want me to take? 10 minutes?
Well,
15?
no, as I said, we only have 12 minutes left and we
Okay.
have to vote. So now you're down to 4 minutes.
Okay.
right.
So I got that. That's fine. So a reminder to some of you on the committee that home health has 4 primary areas that we cover. I'm not going to go all over all of these, but I think what's important for this committee to remember is that home health agencies provide skilled medical care at home. They do preventive care like maternal child health. They do hospice care at the end of life, and they do long-term care at home, which is the Choices for Care program under the Medicaid waiver. So sometimes people think of only one of those things when they think of home health and hospice agencies. And I just want to always make sure that anybody looking at healthcare policy knows that we do all of those things. Home health plays a critical role in the system. I want to highlight for you that we're taking 16% of hospital discharges. Skilled nursing facilities take about 17% of hospital discharges. So without skilled home health, those challenges that we face for getting people discharged from hospitals would be far, far worse. These are it's a critical role in the system. And then we're also reducing the pressure on skilled nursing facilities. So we're taking about 1,000 people, about 2,000 people are getting nursing home care, and about another 1,000 are getting self-directed care at home. So about a quarter of the people who were getting that kind of service, that long-term care service, are getting it from home health. And it is also a less pressure on the cost of the system since people are still in their homes. More pressures than I can go over in the time I have. I want to make sure this committee knows that we lost a home health agency last year. We did not feel the effects the way we might have because another agency took over their designated service area, not the organization. The organization had too many liabilities to be merged. The agency closed, but another agency has taken over their service area. Agencies are in trouble because of not getting reimbursed at the cost of care. This was an agency that took care of a lot of people on Medicaid programs. There's lots of other challenges. 2 I want to highlight. We're getting reimbursed by Medicaid for skilled services at about 67% of Medicare. That's a new number. We haven't been able to compare our Medicaid rates against full Medicare before because of the way the models are so different. But we did a big project with DVHA over the summer, and we agree that this is where we are. And then Choices for Care rates are at least 30% below costs. Rate study from a few years ago said they were 50. We needed a 50% rate increase. I wanted to point this out to you too. This is our payer mix. You see profitable agencies in the country are not taking Medicaid. Vermont agencies take a lot of Medicaid, and this is why the Medicaid program has to pay at the cost of care. We can't keep subsidizing the Medicaid program. There's no federal dollars left for that. Medicare is cutting us, and people are migrating to Medicare Advantage. And so those 2 things are putting a lot of pressure on the bottom lines of home health agencies. This is my last slide, so I am getting to the end. Healthcare reform. So we're about to embark on another healthcare reform journey. And the thing that I observe from a lot of the things we've seen in the past, Choices for Care, the Act 167 report, and the AHEAD model as it was originally proposed by CMMI, they rely on home and community-based services. They don't fund them. So AHS is trying to figure out a way, and I know I haven't, I don't fully understand how the new agreement is going to work for home health. I know that a big part of it was to try to figure out a way to support agencies, but I have to be really clear. If it's not funding, direct funding for rates reimbursed in a timely way as services are provided, it's not going to help us. This is really all about rates and what agencies call revenue cycle, which is how quickly they get reimbursed for their work. So special projects and grants are really great and sometimes fill gaps, but they don't change the capacity of home health organizations to do what I think everybody needs us to do in order for some of the hospital reforms to work. So I will leave it there. Yeah.
Good. Yeah, no, good. I know we're starting to get into the budget request area and what can we do next, in terms of policy. And I think it will all be very good to have you come back and have a conversation about that.
Yeah. Always happy to do that.
Yeah, and I appreciate your time and effort that you put in to bring us the information. If you could please send your slides in.
I did do that. Kiki has them
Okay,
now.
that'd be great.
Yeah.
And then we will see you again.
Great. Thanks,
Thank you.
Senator.
Yeah.
Have a great day.
Time. Yep.
Yeah,
Okay.
bye.
Terrific. So we're going to move on to Helen Laban, for the Vermont Healthcare Association. Just a quick look at who you are and who you represent. And thank you for being here.
Thank you for having me in here to give a quick introduction. So I'm Helen Laban. I'm Executive Director of the Vermont Healthcare Association. You do have slides for me. I am learning from Jill's lesson and not attempting technology right now. I also have the convention of putting all the words on the slides so you can just read them on your own and understand what we're going to talk about. So in my couple of minutes, I'll just let you know what you will find should you explore that introduction to the Vermont Healthcare Association. So we represent nursing facilities, skilled nursing facilities, often called SNFs, along with residential care homes and assisted living residences statewide. And this is a sector they are all providing some form of residential long-term care, and some of them also provide short-term rehabilitation services. They all have different considerations when you look at who they serve, what services they offer, how they are regulated, and how they are paid, including differences between federal versus state control of those things. On the PowerPoint, I include some important distinctions about this sector, which is another way of saying things that people are often confused about. And just to highlight two important ones in there. One is that although these are providers who are serving primarily folks over the age of 65, their main payment source is Medicaid, it's not Medicare. Additionally, while assisted living residences and residential care homes are regulated by state set licensure regulations, which you may hear about this year because it is changing for the first time in 25 years. I was actually in college the last time this changed. I feel both good and bad saying that. The skilled nursing facilities have primarily a federal regulation, and the state is contracted to the federal government to perform inspections. So oftentimes we'll complain about how those facilities don't necessarily fit with what we want for Vermont, but it's not within our control to change as a federal regulation. The big issue that you hear about from our sector is capacity and whether we have sufficient capacity. And I will not go into all the details here, but again, when you look at that PowerPoint, I give examples of what causes capacity constraints and then some basic benchmarks you can use to measure that. Short story is, no, we do not have sufficient capacity. That would be the overall answer there. And then the last just piece is a preview of things you'll hear from us this year in terms of our policy focus. One is, and Jill referred to it as well, that question of whether we have sufficient Medicaid reimbursement for those home and community-based services and long-term care. Another is going to be workforce development, workforce shortages, which are driving a lot of the shortfalls in the funding. And then the question of whether there's adequate reimbursement to skilled nursing facilities. You'll probably hear about that in the Budget Adjustment Act. There were some very important changes that were made last year. We're in between cycles in recalculating those rates. And so those will undoubtedly be a topic of conversation again as well. That's a quick overview of what I've got for my 101. I am always happy to answer questions, probably with more detail than you actually want to see. And just send me an email or give me a call.
It will be important to have you back in, probably at the same time we have Jill in, because this is a huge area for us. Thank you. Thanks for the very succinct overview. Terrific.
Thank you so much.
Well done. compliments.
The last time you'll hear me be succinct.
Well, we have three folks here for Easter seals and, Susan Reed. Is Reed here? Do you want to come up? Or how are you doing? it?
Paul Gibo's actually gonna speak for you.
All right, thank you. Okay, terrific. So Paul, you can introduce yourself and others as you would like, and we'll take about 5 minutes here.
Oh, awesome.
Okay.
I really hope this ends you to your next endeavors with a smile on your face, because we don't have an ask and we don't have a complaint.
Oh,
We're
boy.
really mostly here to
You get
say,
a star.
we are really here to say thank you. We're representing today post-permanency services. Those are contracts that are held by Easter Seals, Lund, and also NFI, who's not here today. And post-permanency really focuses on supporting families that are created by adoption or guardianship. So these are families where we're also looking at trauma, healing, prevention. We do provide direct support to families in their homes, in their communities. So when you think about the counties that we operate in, 6 of them for us: Rutland, Washington, Livonia, Bennington, Caledonia, and Windsor. There's a fair amount of driving and outreach because adoptees don't just live in the central areas. But we think it's important to meet people where they are at and provide what they actually need. And our hope is to keep these families together and healthy. Prior to last year, the program was level funded for 12 years. We really want to say thank you for the $370,000 increase. And this isn't just for Easter Seals, this was a program in the fiscal 25 budget. And it really helps us to attract and retain high quality skilled staff that are providing support to families in these really complicated, often very high need situations. Because adoption is wonderful. I speak as an adoptee myself, and you can create a wholeness and provide predictability and safety and support for a child. But adoptions are also formed through loss. And so we're really looking to address that and focus on healing, yes, but also early intervention and prevention. But we just wanted to say thank you. And again, I hope it puts a smile on your face. I think I can yield to Melissa, if that's okay.
Yeah,
I think we're really tight on time.
No, you're good. You're good. We'll go over 2 minutes. It's fine.
I'm Melissa Appleton. I'm the coordinator of post-permanency services at Lund, and I think Paul did a lovely job of really helping you all understand what post-permanency services are. I did submit written testimony that you probably received already, and there's a parent quote that I will just take a minute to read. It's from a family that adopted through the Vermont foster care system, and I think just represents why there's a need and why we're so appreciative of last year's support and just the ongoing support of the state. And so this is a parent whose child was impacted by early trauma, abuse, neglect, and had multiple foster placements. So lots of loss going into being adopted by his family. And this is what his mom had to say. Thanks to my post-permanency service provider, I learned that parenting children from the foster care system is not intuitive. These children often need the very opposite of what their bodies are communicating. When my son was hitting, kicking, yelling, and yelling profanities at us, he really needed to know that we would not leave him, that we would be able to indeed handle him and his behaviors. It takes a lot of courage, vulnerability, resources, self-care, and support to provide a sense of permanency and unconditional love in this situation. Post-permanency plays a primary role in this for our family, end quote. So I think just that needs don't stop at adoption. These families need ongoing support. They need specialized support. And so we're just really appreciative of this, of last year's support from the legislative session. So thank you. It's right before lunch, so I don't want to keep you all.
Oh, well, you just made our day. Thank you.
Happy to serve.
This is a rare occasion, so we need to really relish it.
We were told it was unusual, but we run really lean. This was a big deal to us.
Yeah.
Terrific. You're all welcome. It was an important thing for the legislature to do.
Yeah.
We're on a roll. I've got captive insurance coming in, and they're the only ones that love the finance committee.
So this is a good day all the way around. We have two folks on finance committee and everybody here in health and welfare.
Love this.
Yeah. Thank you all for coming.